Okay, so this is where we left off on other dividend characteristics. So we talked about a cash dividend. So a stock cash dividend is when a company gives you cash as a dividend, and that's always appreciated. And we talked about stock splits. So a 2-for-1 stock split, you had 100 shares at $10, 2-for-1 stock split, now you have 200 shares at $5. And that's pretty much common sense. And the stock splits can be, typically it's 2-for-1, but they have such a thing as a reverse stock split where you can go, say a reverse stock split would be 1-for-10. So you've got, when you consider a 2-for-1 split, it goes the other way. And for every 10 shares you had, so if you get one stock. So if you had 200 shares, now you have 20 shares. They generally only do a reverse stock split when a company is about to fall off the exchange because they have a minimum of, say, $5 is a minimum to stay on the NASDAQ. So if a company's at $1 per share and they're going to get kicked off their exchange and the stock's going to be delisted, they'll do a reverse stock split to get their price up above $5 a share, and that's the easiest way. But investors generally don't like it, and it's a desperate move, and generally companies that do, once they start on a downward track of a reverse stock split, it takes a long time for them to bounce back after that. Okay. A stock dividend. Now this is where it gets tricky. So this, when it says stock dividend, this is a dividend of stock. So they'll give you 10 shares of stock. So if you have 100 shares and they can declare a 10% stock dividend, they're going to give you 10 more shares. However, it's like a stock split where they're going to readjust the price so that if you had 100 shares at $10, which would be 1,000, now if they give you a 10% stock dividend and you're going to get 10 shares of stock, and the per share price would be $9.09. So the low, just like in a stock split, they'll lower the share price so that you have overall at the end of the day you'll have the same exact amount of money in your account, but you're going to have, it's going to be divided by 110 shares rather than 100 shares. So you're going to have $1,000. On Wednesday, you have $1,000 with 100 shares when they close on Wednesday. Thursday, you have 110 shares at $1.09, both equaling $1,000. So you're not getting any money. You're just getting more shares at a lower price, just like a stock split. But if it's a stock split that's less than 100%, they call it a stock dividend and they give you a smaller percentage. So it's like a mini stock split. Very uncommon, but it exists. And lastly, in the dividend world, we have dividend reinvestment plans, sometimes also known as DRIPs. So this is a way for companies to connect with you directly, the only way that a company could sell you stock directly. Companies generally sell their stocks through an IPO, and then it goes on the secondary exchange and people trade them back and forth. Some companies, there is a law that some companies exploit to sell stock directly to shareholders or employees. And they use what's called a dividend reinvestment plan. And you may not have heard it because companies are not allowed to advertise it as one of the, I guess it's sort of a way the brokers got a concession and all the brokerages were afraid that companies would just all be selling the stock directly to people and bypass the stockbrokers and brokerages and the commission. So I guess they pressured Congress to put a law in there that they can't advertise, so McDonald's can't go create a commercial and say, join our dividend reinvestment plan and invest directly with McDonald's and bypass your stockbroker. So that's why you don't know about it, because they can't directly advertise it, because it would lower the profits for all these financial institutions, and they have lobbyists in Congress and they're able to lobby and limit their ability to do this. Same thing with credit unions. Although this has changed recently, and there was a number of years ago where credit unions weren't allowed to advertise, and they had to limit who they could accept into their membership pools. And because they wanted to keep the knowledge and the idea of what these credit unions stands for. They wanted to minimize the public's knowledge about them because they really are better than banks. So if you're not using a credit union, if you have Bank of America or you have Chase Bank, that's a bad financial move. If you're a student and you live in Suffolk County, you should belong to the Teachers Federal Credit Union because they give you better rates. They give you more interest on your savings, better rates on car loans, better rates on credit cards, less requirements, less fees. I think I've belonged to the credit union for 20 years now. I don't think they've made a dime for me in any type of fee. In fact, if I use Chase's ATM and Chase charges me $3, the credit union reimburses me those $3. Even so, they're paying it for me. And if I use, of course, I use the credit union ATMs are free. But I'm not here as a representative of the credit union. I'm just telling you, if someone has no interest and no financial stake in a credit union, it's a better deal than a bank. Just like the dividend reinvestment programs are better deals than buying stock through an exchange, because with this, there is no commissions and no additional fees. Now, this is to build loyalty. So they want you to join, say, McDonald's dividend reinvestment plan. And then you basically you buy stock through McDonald's directly, and they usually set something up where you make a $100 investment a month, and they'll buy fractional shares for you if you don't have enough money. If you're not investing enough money to buy one full share, they'll actually sell you fractional shares, and whatever dividends that McDonald's pays, they automatically give you more stock. So it's a way for companies to access capital outside of the financial investment banks and financial capital markets. So they could go right directly to employees and other people interested in stock and sell to them directly and keep all the money for themselves. So they don't have to share a percentage with an investment bank if they want to issue new stock. They could issue new stock directly to their dividend investment plan holders. And here it says over 1,000 companies. I think there's more like, from this website, which is just the DRIP database. And the first page it says they have over 1,600 companies on this site, and they have DRIPS 101 will give you some basic knowledge about the dividend reinvestment programs and a list of all the companies. And generally, most likely every company in the S&P 500 and the Dow 30 have a DRIP program, and then many more companies outside of that as well. And so they give you, I guess, links to dividend reinvestment plans of all these companies. So this dripdatabase.com, if you want to learn more about DRIPs, how they work, how to contact companies that have them and buy your stock directly from the corporation and bypass your brokerage account, this would probably be a good site to go to. All right. Now, yes.
But when they issue more stock instead of paying you dividend, aren't they giving more of the company away though? Like, does that hurt them in the long term?
It's usually what they most likely will do is they're buying stock back already and they're paying it out of that. And generally the dividend reinvestment programs. So the question was, is this going to dilute current shareholders? Most companies who provide stock through dividend reinvestment programs are going to buy the stock off the normal markets first and deliver it so they don't dilute. But if they do, it's generally such a small percentage that it's almost undetectable by most companies because very small amount of shares are actually sold this way because there's no advertising, so no one knows about it. So only really a select few who are very cost conscious and trying to reduce the cost of investing as much as possible reinvest through these dividend investment plans. And most of the people involved in them are employees that work for the company because they can advertise to their employees, so they could send in your pay slip or send a memo out saying, and if you work for a public company, they'll probably give you an opportunity to buy their stock at a discount even. And some of these dividend reinvestment plans can give you a discount over the current share price. So if it's capital stock they already have, they could sell it at 10% discount off of the market price. And if they do that, there's usually a limitation when you can sell it. So you can't just automatically flip it right there and make that 10%. So if they do have any cost structure, it may be on selling your stock too early or exiting the plan in total. Now, if it's a lot of this was started mostly to benefit employees. They're not stock options. They're basically employees paying part of their check to the company to buy shares of stock. But it's open to anybody, generally, who wants to do it. So this was really the first program that offered dollar cost averaging, continuous purchasing of individual stocks or individual stock and reinvestment in of the dividends back into buying more shares of stock. And because of when the dividend reinvestment plan started to get a little popular, brokerages started to mimic these abilities to reinvest dividends and to offer monthly contributions. All right, so one other thing about the dividend reinvestment programs, why generally it's not the greatest idea. It's a good idea if you love one company and you just want to be invested in them forever and you're just figuring you're going to hold the stock for a lifetime and you know you're always going to have a long-term involvement with them. It may be beneficial to get a dividend reinvestment plan in some large companies that you feel will be a good company to have for a while. However, here's a big drawback. Say you want to build a diversified portfolio, so you get involved with 20 or 30 dividend reinvestment companies. Now, all of your monthly statements, you're going to have monthly statements from 30 different companies. You're going to have tax statements from 30 different companies. You're going to have, the paperwork involved in maintaining 30 of these accounts becomes tremendous. If you have one brokerage account and you own the 30 stocks within the brokerage account, then they do all the paperwork for you and send you one tax statement, send you one quarterly statement. It just really simplifies things. So the bookkeeping that the brokerage will do for you will be, for most people, probably more beneficial than saving the commissions by getting a 30 dividend reinvestments account, because you have to get a separate account with every company. And companies want you, one thing the company does when you have an account, say you have, I remember Wrigley's Gum, the company that makes Wrigley's Gum, I think they're just Wrigley's. When you're in their dividend reinvestment program, when they send you your statement, they also send you some sample products sometimes, or some coupons, or brand loyalty building documents, because they are what they want to do, and I think Exxon did this, is they want to encourage you or convince you that, like, listen, if you have dividend reinvestments with Exxon, why would you buy gas from anybody else? For every dollar of gas you buy from us, you're helping to increase our profits and our stock price and our dividends back to you. So they try to marketing brand loyalty, and actually the marketing penetration of the marketing products they put inside these monthly or quarterly or annual reports from your dividend reinvestment program are looked at about 5 times the rate of any other type of advertisement. So you get that value pack in the mail, and you're like, oh, value pack, penny saver, pack of other flyers for grocery stores. That's all goes in the garbage. You don't even look at it. But you get your financial statement from Coca-Cola, you're going to open it up and look at it, and if they have some kind of brand building coupon or loyalty thing in there, you're more likely to look at it and read it and be like, oh, what am I getting now? Hershey's chocolate used to actually, at the end of the year, they would give out chocolates with their annual statement. So I don't think they do that anymore. But some of these companies had ways of building brand loyalty to the people who were involved in the dividend reinvestment plans. So this is the only way to avoid broker fees and pay no commissions to buy stock. But generally, you have to sign up for an account where you're making, not in all cases, because each company can kind of write some of their basic rules. But some companies may say that it has to be an automatic, continuous investment, like $100 a month or so. Okay. Now, you don't see them, the last blue chips are probably the last of the chips they still talk about, because at one point they had classifications of blue chips, red chips, white chips, and they were supposed to mimic this basic poker set where you would get colored chips, and the white chips were the dollar chips, and the red chips, which were maybe the $5 chips, and like the blue chips were always the highest valued chips, like $25 or $100. So they took that idea of chips, sort of like chips you'd bet at a casino, although casino chips are multicolored, but it was this basic. You've probably seen these poker sets that come with like these 3 colored chip sets. And they came up with a ranking system for stocks that were related to the value of the colors of chips for gambling. So that's where that term blue chip comes from, is from the poker chips. And blue chips are supposed to be the best, most valued stocks. And that's why they picked blue. they dropped the red chips, white chips, all the other chip uh, this, notations of stocks a long time ago, but they kept blue chip because that was the one that people really resonated the most as a name. And these are so when they talk about blue chips, they're talking about the strongest, the best companies with the uh, usually the biggest, most stable, long-term companies that are around. Generally, anything in the S&P 500 or the Dow 30 are considered blue chips. Um, Steady growth, consistent business, consistent returns, companies that are going to be around for long term. They have a product that is pretty secure and safe, like Chevron, which is gas and oil, Johnson Johnson's drugs and consumer supplies, McDonald's, Pfizer, also drugs. So these are companies that they're not going anywhere anytime soon. And they consistently perform well, and they'll be considered blue chip stocks. And because these companies are so well known and do so well financially, they tend to be a little pricey, and they tend to go up in capital gains terms slower than most stocks, but they're sort of like the uh, consistent returning stock over a long term. And this is just an example of Procter & Gamble, Zach's fact chart. I know you can't read this, but this is just really giving some basic facts about the stock. And they make all sorts of consumer products from, I think they do Colgate toothpaste, deodorants, soaps, things of that nature, stuff that you buy every day for lots of money. Another classification is income stocks. And these are stocks that people who are looking for a monthly income, maybe you're retired, maybe you're skeptical of growth and are scared of the risks. So if you find stocks that have a long-term record of paying annualized dividends that are consistent, we would consider that an income stock. So generally, companies like utilities that have a monopoly of power generation and sales in the area generally grow through the growth of demographics of electricity use, more people or more electronics, or bigger TVs that need more electric or more people having computers. So they have a steady growth and they provide generally a steady trend of dividends over time. And since they pay a high dividend and they pay consistently, they're going to be considered income stock. Generally, food companies, energy companies, cigarette companies are all good examples of dividend stock. Cigarette companies do very well because unlike the United States, most countries in the world smoke a lot. The United States pretty much is responsible for that growth of smoking around the world through movies and TVs productions. They used to smoke a lot in movies and TVs, and that kind of the American cowboy, and we sort of pioneered the industrialization of smoking, and our super effective marketing has, convinced the whole world to smoke. But us ourselves in this country have been moving away from smoking, and you see some of the lowest occurrences of smoking rates, especially say in Manhattan, especially when Manhattan did something where they increased the cost of cigarettes through taxes. Ever try to buy a pack of cigarette in Manhattan? What's it cost? It's expensive, yeah, and that's mostly taxes. And they limited the places where you can smoke. When I was younger, you could smoke everywhere. You can smoke on an airplane, you can smoke in a movie theater, you can smoke at work. It was disgusting. The doctor would smoke in the office, and I think Mad Men had an episode where the doctor comes in and he's smoking, and he's, you know, um, this is also back in the time, and you could watch Mad Men for more of this, where you could drink in the office. You had your alcohol, and not every employee, but if you were a manager or higher, you could have your little couple bottles of alcohol and just have a few drinks at lunch. No big deal. Have a few drinks, drive home. No big deal. You know, um, that's how it was. So it's not like that now. People are more health conscious, but these cigarette companies are still big producers of dividends, because you go to other countries like Korea or China or Russia, and a higher percentage of the population smokes. I'm not saying everyone smokes, but it's a different environment. But their percentages are declining too. So they definitely. So now, and the cigarette companies are more highly regulated in the United States as far as where they can advertise and who they can advertise to. For example, they can't advertise cigarettes on the TV, but they can advertise it in magazines, but they can't make a cartoon character to sell cigarettes to children in this country, but they can do that in other countries. You know, do you ever see that internet video of like the 2-year-old smoking and a 3-year-old smoking? I think he's from Thailand. Yeah, yeah, he's just chain smoking. So that's really bad. But maybe the parents gave him the cigarettes so he would lose some weight, but didn't appear to happen. So anyway, the income stocks are examples of generating dividends. So if you want to have your money in stocks and you like to have some extra cash on the side, you would want income stocks. And this is generally for people who say are older than 50 or looking towards retirement, and because the income stocks are generally safer. Now you have the growth stocks, and this is where most people like to have their money, because growth stocks experience high rates of growth, which equals high rates of return of capital gains and stock price. And what we're looking for here is growth in particularly two areas of what we focus on for growth. We focus on growth of revenues and growth of profits. So if you can have a company that's growing revenues and profits, then Wall Street loves you and you're a growth company. Like Google, like Apple, Netflix, to just name a couple examples. Tesla is a growth company. Even though they don't have a lot of profits, they have a lot of potential and a lot of growth in okay, so here they talk about Amazon, Apple, Google, eBay, Starbucks, Berkshire Hathaway. I guess you could kind of consider that a growth stock. It does grow. It had a great year this year, so not always a growth stock, but in this particular chance, is they do have some elements of growth elements of their stock. So sometimes these growth stocks can also be considered blue chip stocks. There's somewhat of a crossover, but there's always a risk. If Tesla has a hard time developing, selling the new models, or if the expectations don't develop, if certain competition comes into play, there could be a strong pullback on the value of these growth stocks if they face any new competition or stumble, or their revenue growth declines. There are certainly issues with that. Okay, now another classification, and this has been really hot this year, is tech stocks. So they represent the technology sector, semiconductors, software, computers, electronic equipment, and they are considered, most of them are generally growth stocks, but they're a special section of growth stocks. They generally grow faster than growth stocks for most of these. And you think of some of the best stocks lately, we have Facebook and the social media sites. LinkedIn has gone up tremendously. And then also this year, even Microsoft had a great year. Still doing very well. Cisco, they actually had some problems recently, but Yahoo, NVIDIA, SanDisk. NVIDIA makes video graphic cards. SanDisk makes memory and storage and MP3 players. Intel, processors, Electronic Arts, computer games. So these sometimes, the tech stocks can have a whole range from, include blue chips like Microsoft and Apple, to more speculative and risky stocks like Twitter, which is, when IPO this year. But they're very potential. They have a lot of potential for growth. And people are generally knowledgeable about these tech stocks or use their products, so they have a familiarity with them. So they sort of have like a built-in demand where people want to buy and own the stocks that they can identify with or understand the products of. And generally, tech stocks, when you have a booming tech environment like we have right now, the last time we had this was, say, in 1999, they can sort of run away and their price can sort of get to a point where it's a little crazy. And we had talked about PEs last class, and the PEs of some of these tech stocks are really much higher than the average of the market. So that's what makes them a lot riskier. But these stocks generally have better momentum. They're a little bit sexier. That creates more demand for them, and that's why their valuations sometimes get out of control. So here's a tech stock on Electronic Arts, and Electronic Arts is basically a company that recently has been doing better, but they had some hard times So let's just look at the where are we? Let's just look at, we'll go to Yahoo Finance and we'll look at electronic arts and get an idea. And the symbol is EA. Their big thing is their sports game, like Madden football. Has anybody ever played that? Okay, so they're at $29. So they had a 100%, almost 100% gain this year from 16 to 30. But you could see if I pull up a 5-year chart, you'll see that early in 2012 they went down quite a bit to they were under $12, and they recently had a big turnaround. So in probably about the summer of 2012, they had some trouble. Earnings growth of the revenues and earnings were declining, and the stock got punished badly for that. And then since they've been able to turn around and get back in the growth track, the stock is at an all-time high for the past 5 years. It's also, part of it also has to do with the bubble that's sort of inflating in the tech industry that's pushing all tech stocks higher as well. So it's a twin force of the company doing better, plus the bubble demand aspects for technology. Also, biotechnology is very hot. The bio stocks is another very hot category of stock that's doing very well in the markets. All right. So Zacks is just an example. If you go to their website, you can get a little mini sheet of the facts of the company to sort of look at their estimated price targets. And you can see here that this is not too old, actually. This came out, this fact sheet is in June 2012. Remember, we're talking about EA in 2012. And they had, the current price was $12.79, sort of at the low. And they predicted it was going to go to 13. So maybe this was 2010. So they didn't have much of a big prediction for EA. So a lot of this research on these stock charts aren't generally that useful as far as future prediction of future stock prices, but they are useful to get an idea of overall what's happening with the company, because they give you a little summary of the company and what's currently happening with them, plus their key financial figures, which we'll talk more about next chapter. Okay, then the riskiest category of stocks is speculative stocks. And a lot of people in the trading simulation like to go for these speculative stocks because they have the most volatility. And that volatility is what can earn you big returns. So companies that may be have a potential for a huge price gain. For example, a biotechnology company that has a new drug that's about to be approved is going to have a huge price change. A company that could be an up and growing industry like satellite radio, Under Armour for sports apparel and shoes, athletic shoes. They have a lot of risks, but also a lot of potential. So that's why they're in the speculative category. So speculative stocks sometimes can pay off quite well and have, there's this term called bagger. A 2-bagger, it means you double your money. A 5-bagger means you make 5 times your money. So a speculative stock can sometimes be a 10-bagger, and that's a Peter Lynch term, who's the undisputed greatest mutual fund manager of all time. He has a book called One Up on Wall Street. If you wanted more insights of trading in stock world, the One Up on Wall Street is a classic investment textbook by the person who's had the most successful investment record of all time, Peter Lynch. So that it's an easy read, and it reinforces a lot of the basic principles of this class and gives you a lot of tips on how to buy stock, how to use the skills you already possess today as a participant in society and a consumer to help you to make investments. So, okay. We have cyclical stocks that, since our economy is cyclical, we have expansions, which right now we're in expansion, a 5-year expansion, and soon we'll have a contraction in another recession. And I know this because every time we have an expansion, it's followed by a recession. And every time we have a recession, it's followed by an expansion. So we just don't know exactly when this is going to happen. So we have this expansion and contraction of the economy, and that affects different stocks differently. Some stocks, it has no effect. if you're a fast food restaurant like McDonald's, a recession sometimes helps you because people say, I'm not going to go to Outback or PF Chang's or Cheesecake Factory and spend $50 for two people to have dinner. We'll just go to McDonald's. So sometimes the fast food chains experience no change or a slight increase of sales during a recession as people everybody trades down to a cheaper restaurant when they feel like, money's an issue, money's a problem. And I don't know what happens if you go to fast food restaurants, what happens? I guess you eat at home then. And if you're eating at home and you can't afford to go to restaurants, then you just go hungry. So nobody likes a recession for those reasons. But cyclical stocks, some of them, will do better in an expanding economy and do worse in a declining economy. So these stocks sort of say automobiles is a classic example of this. When the economies are good, like right now, more cars would be sold. When we have a recession and people get worried about their money, they don't want to make a financial commitment to cars. So that's why you saw in the last recession, GM, Ford, Chrysler all having financial crisis, potential to go bankrupt, government bailout, because people just stopped buying cars during the last Great Recession because they were afraid. And now that recession is over, car sales have gone up tremendously and they're making record profits. So food companies are, well, I'm going to talk about defensive stocks in a minute. That would be considered a defensive stock. But the cyclical stocks, usually consumer electronics can be cyclical, computers, things that are expensive to buy that you're only going to buy when you feel confident about your job and the economy. Those companies do better when the economy is growing, but will do worse when the economy is contracting. We also have defensive stocks. These stocks do well whether the economy is growing or contracting. So if we talk about beverage companies, beer companies are going to do well or maybe even better during recession because people get depressed, upset, they drink more. So generally, soda companies, beverage companies, food companies, drug companies, you're not going to say, oh, it's a recession, so I better cut back on my prescription medications and, I'm just going to tell the doctor I'm going to stop taking my Lipitor, my high blood pressure medication, and because, it's a recession, I got to cut back. No. People are not going to cut back on their prescription medications. People are not going to cut back on the staples that they need every day. And in fact, companies like Walmart and Kmart or food companies like Campbell's Soup are very defensive because sometimes they'll actually be stable or grow during a downward cycle as people trade down to eating at home more or buying more from the supermarket and making meals at home and not eating out as much. Something that's definitely a more cyclical industry is travel. Hotels, and resorts will have a hard time during a recession and do better during an expansion. Companies, they put this company down here, WD-40, which you would never think is a good company, but it's been a great stock and a very defensive stock. So it doesn't matter. If you need WD-40 for something, you're buying it. And if you don't know what WD-40 is, because your parents do everything for you, it's this miracle lubricant that you could use on door hinges and cars and car hinges and just about any time you need to loosen a screw or something, WD-40 is there. It works like magic. Everybody should have a can of it in your garage. Ask one of your parents. They probably know what it is. All right. So we talk about capitalization, and this term market capitalization has been in discussion with us before, and it basically looks at the size of the company as denoted by its stock price and its outstanding shares. You take your stock price, you multiply it by its outstanding shares, and you get your market capitalization. So these small, mid-cap, and large cap, and the cap refers to market capitalization. This is just a generic sort of bracketing. Some other textbooks, some other places classify the amounts in different money. But generally, for most people, small caps are stocks under $1 billion in capitalization of their stock. And that's still a pretty big company. A lot of companies on Long Island that people work for are considered small caps and have less than $2 billion worth of market cap. Then you have mid-cap stocks, 2 to 10 billion in market capitalization, and then you have large cap stocks, more than 10 billion. And those are generally S&P 500 and Dow 30 companies are all large caps. Now, it's important to know the differences of these segments because small caps grow in different tend to grow faster and grow in different segments of expansion than mid caps or large caps. So a lot of research has been done is should I put all my money in small cap stocks and because they tend to outperform large caps but be more riskier. And the reason for the small caps, do we have okay, we're going to talk about each of them individually. So let me just start with the large caps then. So the large caps, these are the big companies that represent almost 80 to 90% of the total value of all the stock markets. Um, they're a smaller amount of these companies, but their valuation makes up a majority of the U.S. stock market. But bigger isn't necessarily better because it's sort of like turning the Titanic. These companies are slow to move. Um, it's hard for them to double sales when you have $500 billion in sales. How do you go to $1 trillion in sales? It's just going to take a longer time. So their growth rates, the bigger the company gets, the slower their growth rates tend to become because of the sheer size of the companies. But they're generally considered much more stable and reliable types of investments and often considered also blue chips. Now, the mid caps, these are the companies where I think generally most of my investing are in mid caps. These are companies that we feel comfortable with because they've gotten out of their teens or their small size and become more established and more larger company, but not so big that they can't still have a lot of growth ahead of them. So some examples I give: Logitech, American Eagle Outfitters, Garmin, which makes the GPS. So these are companies that are well known, established, have big operations. They're not super giant sized companies yet, but they're sort of on their way. I guess Under Armour could fit in here as well. Sometimes they're called the baby blues. They're sort of like the smaller blue chips in some classifications. They can be around for many years. They could just service a smaller segment or have, be involved in business that just isn't a huge business overall. So they just maintain a smaller mid-sized type of company. And these can be, a great variety of companies, but generally they're not giant conglomerates or giant companies. They're just sort of companies that are big, but not too big. And they're generally a mix of the benefits and the weaknesses of large caps and small caps combined. So depending on the individual mid-cap company, they'll have a unique set of benefits and drawbacks based on what industry they're in. But generally, you can feel a little bit more. They're less volatile because they're mid-size standing of a company. They have a little bit more staying power. They're a lot less risk than, say, a small cap. And the small caps, you could have a $200 million, $300 million company be a small cap, or a $1.9 billion company. So there's a big range and a big variation in the size of these small caps. They generally are newer companies with not as much of a financial track record. They could be companies you recognize that just haven't grown into being a mid cap yet. So if you could get a small cap that's on the way of becoming a mid cap, ideally your best investment would be to invest in a company when it's a small cap, hold that company as it grows into a mid cap, and keep holding that company as it grows into a large cap. So if you can get on board a stock that's going to transition from small to large cap, then you're going to make a tremendous amount of money. So one advice I give to students looking at stocks, if you're looking at small cap stocks, sort of like Tesla for a while was considered a small cap, still may also be considered a small cap. I'm not sure. Well, actually now its capitalization is quite big because the stock went up 500% this year. But at one point, it was a small cap, and that would be the time to own it. Now that it's graduated into mid cap, almost probably large cap by now, that was quite a ride, a 500% increase in 1 year. Though that's the stocks you want to grab hold of. You wanted to invest in Netflix when it was a small cap, and now it's a large cap. But once it gets to be a large cap, the growth and the returns can slow quite a bit. So you want to kind of identify the stocks that are moving up through the ranks of small to mid to large, and you want to get them on board that train and ride the momentum as long as that company, like a company like Under Armour, as that started to gain a foothold in apparel and then moved to shoes and cleats and everything in the sports area, it has the potential to be another Nike, which is a large cap. And right now, Under Armour is probably a mid cap. Okay. Anything else about small caps? Okay. And of course, the small caps are more risky, more speculative, and a lot of times it doesn't work out. Some companies come along and disappear, go bankrupt, or it just doesn't work out for them. So there are definitely a lot more risks. Now, as we did talk about this before, but there's also foreign stocks, international stocks, and with the globalization of the financial markets, more and more stock monies and stock capitalization is outside of the country. Now, 6 countries of the world make up 80% of the world's stock market. The United States represents 35% of the total world's capitalization. That's down from 50% about 15 years ago. So the rest of the world, as they're growing and their stocks are being more invested in, the equity market is shifting, with one of the biggest growth areas being China for stocks. But still, the U.S. stock market is tremendous. A value, usually the value of our stock market, I think right now it's close to 20 trillion, maybe even 25 trillion. It's big. And most of the returns of non-U.S. stock markets are due to currency exchange rates and not the markets itself. So if you can invest in a overseas market, that market may only have a 2% return, but if the currency goes in your favor, it could wind up being a 20% return just on the currency alone. So that's some of the risks. You know, these risks we talked about before about investing in foreign stocks. But to be truly diversified and have a safer portfolio, you would want to have a proportion of your allocated portfolio in international stocks, because a lot of the American stocks, they're doing well, and American exchanges have done well in the past couple of years, but that's not always going to be the case. You sometimes want your money where the growth is. So if the growth is in China or India or Europe, you want some of those companies that are expanding growth over there, especially if those companies are starting to sell products to the United States. So you can have an international company that develops a new product, like maybe Sony develops the new PlayStation 4, and that could, or Nintendo develops a new game console. They can make a lot of money for a small company in a foreign country if they start to expand into the U.S. markets and exchange and trade in our markets. And if you want to go global, there's a couple options that you can choose from. You can buy excuse me, shares directly from foreign markets. So you can go to the Toronto Exchange and buy Canadian stocks directly, but you have to convert your dollars to Canadian dollars and buy the stock in Canadian dollars. And then when you sell it in Canadian dollars and convert it to US dollars. So there's additional red tape, additional commissions you have to pay to do that, and can be some tax problems, because you may have to pay additional taxes or taxes in the foreign country. It depends between countries. If you buy ADS, American Depository Shares, this will solve those taxation problems, those currency exchange problems, and you buy them directly on the U.S. market, and they'll trade in U.S. markets, they'll trade in dollars and pay dividends in dollars, and they'll seem very much like a dollar denominated stock. So that's one way of solving those problems. And an even bigger way of solving these problems is to buy an international money mutual fund. So you buy a mutual fund that specializes on international stocks, and you can get them by total world or Asia, Europe, Africa, Middle East, Far East, Pacific Rim. There's all different classifications of these foreign stock mutual funds. They even go as detailed as individual countries. So you can have a stock fund just for English countries or companies, or Chinese companies, or Japanese, or Mexican companies, and you can buy in a specific country or a pack of countries. So it's easy to get a global influence in your portfolio, but it's quite necessary if you're going to have a portfolio that's forward-looking, especially if you're going to be investing in stocks for the next 40 years. You're going to want to have a significant portion, maybe even 50% of your portfolio, be international for the next couple of decades moving ahead. Even though it is riskier and sometimes can be more complex if you don't understand, if you've never seen the company or its products, if they're not available here, they're only available internationally, you may not be as familiar with their operations or how they make money. And this is true for a lot of some of the Chinese companies that people invest in, they might not fully understand them because they don't know what the product is. They don't know how it's applied. There's a company that's sort of like a Chinese Facebook that's doing very well because it's associated with Facebook, even though it's a completely separate company. But you don't really know what that product is unless you've used it and you could read one of the Chinese languages to see how functional it is. So international investing requires more work on your part as far as to pick the right market or country and then pick the right stock within that market or country. And you always have to think about the currency fluctuations. And right now with the dollar getting stronger, foreign investments are probably going to have a weaker return. But we definitely, if it looks like the dollar is going to go weaker, you definitely will want to have more foreign investments because they could gain 5 to 10% in value just from the currency shift. All right. And of course, the returns, add one little wrinkle if you want to calculate the returns in a foreign currency. You have to calculate the income, the dividends, the capital gains, and then the change in the foreign currency to get your total return in US dollars. So even the calculations of return have another wrinkle because you have to adjust for currency differentials between. Other types of alternate investments or alternate investment strategies. One could be a value strategy where you want to have just high quality blue chip stocks that aren't speculative, that hold a lot of value. Maybe they're even undervalued as a stock price. And you want to just really focus on not growth, not speculation, but value. And that's a sort of a investment plan. Capital accumulation plan would be more of a growth plan where you want to put your money in growth stocks. And when that stock stops growing, you want to cash out and put it in new growth stocks. So you're always looking to improve your capital gains through growth-oriented stocks. And it's really a momentum strategy. You get on board stocks that have good upward momentum, and you stay on them until they start to level off, and then you move into what's hot next. So you would trade more frequently with that type of strategy. There's also an income strategy where you're just primarily saying, hey, you know what? I don't want to work anymore. How can I do that? I want to be home and not working because I hate work. Because it sucks. Well, you get enough money in bonds or municipal bonds or income dividend paying stocks that can generate, say, $4,000 a month in dividend income. Now suddenly I could stay home and I have an income. My money is working for me. I'm not working for my money. Wouldn't that be nice? That's what some people's goal for retirement is that they want to get enough money in these income generating portfolios that they could live off of it. And then when they pass on, they could still have a huge retirement nest egg to give to their heirs rather than just chewing through all their retirement money. They let their retirement money generate their retirement income, and they still always have that nest egg, which is probably, I think, the best retirement to have because you never have to worry about running out of money. Because if you're just using your retirement money and eating through it, and if you run out, if you live to 110, which is quite possible for most people in this room, not for me, but by your age, when you get to be 60, 70, they probably have wonderful medications. They'll clone you a whole new body and transport your consciousness into that new body, and maybe you can live 200 years. No? Well, maybe they'll make an android, and they can kind of put you in an android body. Or you could live in a computer. They'll just put your whole mind, consciousness in your computer, and you can just play Minecraft for the rest of your life. You know? I don't know for sure. I'm not a scientist. Yeah, I heard that you could do programming inside of Minecraft, make like a small 8-bit computer. Um, another strategy. This is one that I do utilize. It's called buy and hold. I'm like a hoarder. Ever see that show Hoarders? That's me. I don't hoard junk and have like a kitchen. Ever see those kitchens and you have to climb over, walk over all the. Now that my house is pretty immaculate, but my stock portfolio they should have a hoarder's stockholders edition because I buy stocks and like to hold them forever. I told you about that lesson I learned from Apple, where I bought Apple at split adjusted would be like $6 a share, and I sold it when it was $30 a share. And I thought I was the best investor in the world because look how much money it was a 5-bagger almost. However, that stock went on to what, 800 or something like that. So that's why I like to buy great companies and hold on to them for long term. So, and only sell when they fundamentally change. And, if McDonald's was going to certainly change from a fast food company to a tech company, I might want to sell that. But as long as I like the stock and it's doing well, I'll just hold on to it forever. and just let the dividends keep growing and let the value of the company grow with the economy. So it's very conservative and a low-cost approach to do buy and hold. When I get older, I'll probably switch to more current income, like I was talking about before, and try to build a portfolio where I could retire early and just live off the income of my investments through dividends, through various sources. Stocks, bonds, municipal bonds can all generate nice dividends. Long-term quality growth is similar to the buy and hold approach, and but it throws in the additional wrinkle of looking for more growth-oriented opportunities. So like Under Armour would be a long-term growth stock, it's not a traditional buy and hold stock like, say, McDonald's, but it'll be a stock that looks like it'll be good for a long term and is right now in a growth phase. So the capital gains are what I'm trying to get over a longer term by looking for the best quality stocks today that look like they'll grow for the next 10, 20 years at a faster pace than, say, a blue chip stocks. So it's sort of a play on that buy and hold, but more specifically looking for growth-oriented opportunities in a more quality stocks available. And so if I felt Facebook was going to be a stock that's going to be with us for the next 20 years, I would buy it now, even at a high price, because I feel like it's going to be it's going to be with us for the next 20 years, which that remains to be seen if that's going to occur. Now, this is what a lot of people are doing in the virtual stock exchange, aggressive stock management. So people are putting $500,000 into Tesla, letting that make 100 or 200,000 and selling it, and putting a lot of money in Google and or other small stocks and just trading very aggressively to get that capital gains. And it could be you could buy hopefully you're buying high quality, if not, you could still be aggressive with lower quality. But the idea is to get in at a low price, have the price go up and sell it, and continue to do that for shorter periods, not day trading, but we're talking weeks or months at a time. So it's market timing is sort of a key to this. You want to sell when things seem overinflated, like right now, and buy back when things cool down and prices go down. So you're looking to be a little bit more aggressive. So this would be an account where you're trading 2 to 10 stocks a month. Day trading would be trading 2 to 10 stocks a day. So it's not quite as active as day trading. But speculative and short-term trading would be trading 2 to 10 stocks a day, or day trading. And a lot of us are doing this in the virtual stock market. And if you're doing this and losing money, that's a good lesson. So if you come in last place because you were day trading and you lost a lot of money in the virtual stock market, or one time you made money, then you lost a lot of money, that's a great lesson. So coming in last 10 positions by doing this is a good lesson, because then you won't duplicate it in your real portfolio in real life, because aggressive and speculative short-term trading only works out for a very select few. For most people, they fail at it and lose a tremendous amount of money and just give up in trading for the rest of their life. But the idea is, you got this already. I can see most people doing this, where you buy a stock. Hopefully, you buy 5,000 shares of stock. If it goes up $1 or 25 cents, you sell it, keep the profit, move on to the next stock. And you look for stocks that are hot that day, and you're really just trying, you may even not know what the company does, their full financials. You're really just trying to trade on the volatility of the stock price. So you hold it for very short term times, and you're hoping for, maybe you buy a stock before earnings release and hope it pumps up 10% and sell it, and you just continuously emphasizing trying to make these capital gains because the more money you have to invest, the more returns you can make because of the scale. Okay, so that's the end of chapter 6, and we reviewed the basic appeal of common stocks, why we love them, described the different returns, historical, different standards of performance. We talked about stock quotes and stock costs and characteristics. We understand different types of common stock values, discussed all sorts of dividends, including dividend reinvestment plans, and described various types of common stocks. And who knew that learning goal 5 and 6 would be as long as the first 4, but that's what happened today. Okay, so that is chapter 6.